Imagine looking at a financial asset that is just actively flashing this massive, undeniable, strong sell signal across basically every single technical dashboard.
Oh, yeah, across the board.
Right. We are talking about a chart trapped in just a brutal downtrend, bleeding value almost every single day. I mean, by all traditional metrics, it looks exactly like a sinking ship.
Completely.
But then you look closer, and over just the last 5 days, investors have inexplicably dumped over $114 million right into it.
It's wild, honestly. It's like you're watching a building actively crumbling, and, all these massive institutions are just rushing inside with briefcases full of cash.
Exactly. Makes zero sense on the surface. And hey, before we get too deep into this, make sure to like the video, subscribe to our YouTube channel, and absolutely leave your comments and feedback down below. We really want to hear what you think about this.
Yeah, definitely let us know.
So today's deep dive is all about dissecting the ProShares UltraShort QQQ, which most people know by its ticker symbol QID.
Right, the infamous QID.
Yeah. And our mission today is to take this massive stack of market data, the fund operations, the technical analysis, and figure out what this ETF actually does behind the scenes.
Yeah.
We want to figure out for you whether this is some hidden undervalued bargain or just a massive value trap.
And why so many everyday retail traders get absolutely burned when they touch it.
Totally. Now, real quick, before we pull the engine apart, we need to set some boundaries. We're purely examining the provided data and the underlying market mechanics to help you read the landscape. We are absolutely not giving any financial advice here.
No, definitely not. This is just an analysis. Because when we look under the hood of QID, we aren't just looking at a normal stock. We're looking at a highly complex derivative instrument.
Right.
It's essentially acting as a battleground between, massive market momentum on one side and sudden geopolitical fear on the other.
Okay, so to make sense of that crazy $114 million cash inflow we mentioned, we have to look at the crime scene first. I mean, the current price action, on paper, is a complete technical bloodbath.
Oh, it's terrible.
Let's look at the actual quote in history for today, April 14, 2026. So QID is currently trading at $19.11. It's down 3.53% just today.
Which is a big daily move.
Yeah, but zooming out is what tells the real story. Because almost exactly a year ago, April 21, 2025, this fund hit its 52-week high of $42.43.
Wow.
I know, it has lost more than half its value, and right now it's just scraping the absolute bottom, sitting near its 52-week low of $18.87. So who is buying and selling this thing, and what are the charts actually saying?
Well, the technical consensus right now across basically every analyst rating is a resounding strong sell, and there's a very mechanical reason for that.
What's the main driver there?
The price is currently trapped below every single key moving average. So it's sitting under the short-term 5-day average, which is at $20.25.
Okay.
It's below the 50-day average at $21.40. And it is just miles below the long-term 200-day moving average of $21.63.
And in technical analysis, those moving averages kind of act like physical ceilings, right?
Exactly. They are massive levels of resistance. So QID doesn't just have a ceiling above it. It has 3 thick layers of concrete pushing it down. Every single time it tries to bounce, algorithmic sellers just swat it right back down.
Man, and the momentum signals are just as bad, right?
Yeah. If you look at the MACD, the moving average convergence divergence, which measures momentum, it's sitting at a highly bearish negative 0.360.
Right, but I'm looking at these same technical indicators, and one thing really stands out to me. The RSI, the Relative Strength Index, is sitting at 33.86.
Okay, yeah.
And usually, an RSI approaching 30 is textbook oversold territory. So a retail trader might pull this up and think, hey, this asset is totally exhausted. The selling has to stop eventually.
That's exactly the trap.
Right. They might think it's undervalued. It's a beaten down asset just waiting for a rebound. Are they right to think that?
Yeah.
No, the order flow completely shatters that whole undervalued narrative. Because yes, the high volume profiles do show a heavy amount of interaction right between $20 and $20.30.
So people are trying to buy the dip.
Oh, people are definitely trying to catch the falling knife. But the aggressive selling volume is currently running between 13 million and 16 million shares traded daily. It is entirely overpowering any of that buying support.
Just washing it away.
Exactly. And more fundamentally, applying the word undervalued to QID reveals a massive misunderstanding of what the fund actually is.
Yeah, let's get into the financials, because if you're a listener and you go to look up the income statement for QID, expecting to find like quarterly earnings, an annual balance sheet, or a regular cash flow analysis, you're going to find a completely alien structure.
Right, there is no factory making widgets here.
Exactly. If you buy a share of QID, you're not buying a slice of a company that manufactures a product, generates revenue, and reports a profit margin. What are you actually buying?
You're buying a pile of contracts. The fund holds exactly 0 shares of technology companies. None.
0.
Because QID is an inverse leveraged fund. Its stated goal is to provide a negative 2x or, a negative 200% daily return of the NASDAQ 100 index.
Okay, so if the NASDAQ goes down 1% today, QID is mathematically designed to go up 2%.
Exactly. But to achieve that without physically going out and short-selling hundreds of individual tech stocks, its balance sheet is basically constructed entirely out of cash and derivative contracts.
So ProShares isn't actually out there shorting Apple or NVIDIA directly. They are managing this massive pool of institutional agreements.
Yeah, the primary exposure comes from inverse swaps with major banks.
Right, so ProShares takes a giant pile of cash to a bank, like, say, Goldman Sachs, and essentially signs a contract that says, hey, if the NASDAQ drops $1 today, you owe us $2. If the NASDAQ goes up $1, we pay you $2. It's just a massive side bet.
That is the exact mechanism, yeah.
Yeah.
Currently, ProShares has swap agreements with Goldman Sachs, making up negative 42.88% of their exposure.
Wow, that's huge.
Then they have Nomura at negative 32.87%. And Bank of America at negative 28.05%.
And the banks are just taking the other side of the bet to collect fees.
Mostly, yeah. They use it to hedge their own massive portfolios, or they simply act as market makers to collect those premiums.
Okay, but to back up those massive bets, the fund has to hold a literal mountain of collateral.
Right. They can't just make the bet on credit.
Yeah, so looking at the actual cash flow and capital sitting in the fund, it's heavily weighted in cash equivalents. Specifically, 61.60% of the fund is parked in the ProShares Genius Money Market ETF.
Yep.
And another 18.64% is just sitting in U.S. Treasury bills.
Which actually brings up a very unique dynamic to holding this ETF.
I was just going to ask about that because I was looking at the cost versus the payouts. The expense ratio for holding QID is just brutal.
It's incredibly high.
It's 0.95%. You are paying nearly a full percent of your investment every single year just to pay ProShares to manage these complicated swap agreements. But, and this is the crazy part, it also has a dividend yield of 5.26%.
Yeah, which confuses a lot of people.
Right. It pays an annual rate of $1.04, and the last payout actually hit on March 25, 2026. Where's that money coming from?
Well, the cash they use as collateral for those swaps is sitting in those treasury bills and money market funds we just talked about.
This is earning interest.
Exactly. Those instruments generate high interest right now, and by law, the fund has to pass a portion of that generated yield back to the shareholders.
Okay, so paying to hold QID is essentially like paying an expensive premium for a very specific type of earthquake insurance.
That's a great way to put it.
You're betting that the tech sector is going to completely collapse. But because the insurance company takes your premium and parks it in high-yield government debt, they actually pay you a little bit of interest on your premium while you just sit around waiting for the disaster to strike.
Right. And the total assets under management, the AUM for QID right now, is roughly $329.81 million.
So that massive pool of capital is just people buying this earthquake insurance policy.
Exactly. They accept that steep 0.95% management fee. They collect their roughly 5% yield from the collateral, and they actively root for the NASDAQ 100 to just have a catastrophic day.
Okay, wait. If people are getting paid a 5% yield to hold cash equivalents that bet against the market, why are everyday retail traders losing their shirts?
Here's where it gets dangerous.
Right, because the insurance pays out eventually, doesn't it? I mean, the NASDAQ doesn't just go up forever. There are red days. So why are there so many horror stories of people holding QID and watching their accounts just vaporize?
Because of the downside risks, specifically a mechanism called volatility decay. And this is triggered by something called daily reset risk.
Daily reset, meaning what exactly?
Well, the key word in the entire QID prospectus is daily. It aims for negative 2x returns for a single trading day, period.
Just one day?
Yes. When the closing bell rings, the fund has to mathematically rebalance all its swap agreements so it can start the very next day with exactly negative 200% exposure.
Okay, can you walk us through the actual math of how that plays out? Like, say I hold it for just a week.
Sure. Let's use clean numbers to see the trap. Let's say the underlying NASDAQ index is currently at 100 points, and the price of your QID ETF is also at $100.
Got it. 100 and 100.
On day one, the market has a terrible day. The NASDAQ drops 10%, going down to 90 points.
Okay, and because QID is a negative 2x fund, it jumps 20%.
Exactly. Your QID is now worth $120. You're thrilled.
Yeah, I'm up 20 bucks. I'm feeling like an absolute genius right now.
Now, day two happens. The market recovers. The NASDAQ goes from 90 points back up to 100 points.
Okay, so it's back to where it started.
Right. But mathematically, an increase from 90 to 100 is an 11.1% gain.
Ah, and because QID moves at negative 2x, my ETF has to drop by 22.2%.
Correct. But here is the kicker. It drops 22.2% from your new baseline of $120.
Oh, man. So 22.2% of $120 is, what, $26.64?
Exactly. You subtract that from your 120, and your QID is now worth $93.36.
Wait. The NASDAQ started at 100 and it ended at 100. The market was perfectly flat over 2 days.
Yep.
But I just lost almost 7% of my money just from holding it.
That is volatility decay in action. The friction of the daily reset mathematically punishes you every single time the underlying index moves back and forth. You don't even need the NASDAQ to go on a massive bull run to lose money in QID.
You just need it to be volatile.
Exactly. You just need it to bounce around.
Wow. So holding QIE long-term is basically like trying to walk up a down escalator.
Very much so.
Every single night at the closing bell, the escalator speeds up. Even if you take a step forward on a red market day, the baseline friction of that daily reset is constantly dragging you back down to the bottom floor.
And over the long term, that friction grinds the asset to dust.
How bad does it get?
Well, the data from our sources highlights a terrifying statistic. Over a 10-year period, the compounding effects of that daily reset lead to massive value erosion. We are talking about maximum drawdowns of negative 99%.
Negative 99%.
Yeah, it is an instrument fundamentally designed to go to zero over a long enough timeline. Furthermore, quantitative AI models and market analysts currently give QID a 90% probability of further decline.
90%?
Yeah, purely because the underlying NASDAQ shows so much resilience right now, staying above its 50-day moving average.
Okay, I'm looking at this 90% probability of decline, and it makes zero logical sense when you pair it with the data from our introduction.
And inflow data.
Yeah, the math practically guarantees destruction over time. The underlying tech market is booming. So that massive $114 million inflow over a 5-day window, is this just pure gambling, or is there a mechanical reason massive institutions are buying a guaranteed loser?
To understand the inflow paradox, we really have to separate long-term investing from tactical, short-term hedging. Look at the flow metrics again. Over the past month, the net flow of cash into QID was a relatively modest positive $9.05 million.
Right.
But that massive spike of positive $114.22 million happened in a highly compressed 5-day window. Institutions are not looking to hold this for a year.
They're looking to hold it for, like, a Tuesday.
Exactly. It's a surgical strike.
So what exactly happened in that specific 5-day window to trigger the bull case for buying QID?
Well, the sources point to the intense geopolitical tensions in early April, specifically regarding the conflict involving Iran.
Right. And again, just looking strictly at how market participants react to geopolitical uncertainty, not taking any sides on the event itself.
Exactly. When we look at the market reaction, the behavior becomes very logical. Imagine you manage a massive institutional fund holding billions of dollars in Microsoft, Apple, and Nvidia.
Okay.
News breaks over the weekend that could threaten global stability and maybe trigger a massive market sell-off on Monday morning.
But you don't want to panic sell your core tech positions. I mean, if you sell off your Apple stock, you trigger massive capital gains taxes, you lose your voting rights, and you give up your long-term position in a great company just because you're scared of a one-week news cycle.
Exactly. You want to hold your Apple stock, but you need immediate protection. So you take a fraction of your cash reserves and you buy a massive block of a negative 2x ETF like QID.
So if the market crashes on Monday morning because of the geopolitical news, your tech portfolio takes a hit, but your QID position spikes aggressively, offsetting those losses.
Yes. And once the fear subsides and the market stabilizes, you immediately sell the QID. You just accept a small loss on the volatility decay as the cost of doing business.
It really was just a temporary insurance premium.
That's all it is to them.
So we basically have two entirely different games being played on the exact same field, which totally explains the massive daily volume.
Yeah.
Retail traders might pull up the chart, see a $19 price tag, remember that it used to be $42 a year ago, and think, wow, this is a cheap asset. They buy it, and they walk straight into a mathematical trap that will decay their money to zero.
Well, institutional players are perfectly aware of the trap.
Right. They're just renting QID for a few days to use as an umbrella because they saw dark clouds on the geopolitical radar.
Exactly. One group is buying an umbrella for a storm, and the other is trying to buy real estate in a flood zone.
That's a great analogy. So what's the bear case against QID then? I mean, why are there 13 to 16 million shares aggressively sold every single day?
The bear case is driven by the reality of the broader economy. The relentless AI-driven boom currently supporting the S&P 500 and the Nasdaq 100 acts like gravity against any short bets.
Right, because automated algorithmic buying in the broader market constantly pushes tech stocks higher. That has to create a persistent headwind that actively suppresses these inverse ETFs.
Oh, absolutely. Even if the market goes sideways, the algorithms are looking for slight dips to buy, which prevents the sustained downward momentum QID needs to actually generate a return.
So the underlying strength of the tech sector basically limits the effectiveness of the hedge anyway.
Right. If the market drops 2% on bad news, but retail and institutional algorithms immediately buy the dip and push the market back up 1.5% by the end of the day, QID barely registers a gain before that daily reset locks in the volatility decay.
Wow. Okay, so synthesizing all of this data from the financials, the moving averages, the fund operations, what is the ultimate outlook on QID depending on your time horizon?
Well, in the short term, QID remains highly bearish as long as the tech sector maintains its current momentum.
Right.
However, it will continue to act as a highly reactive thermometer for global anxiety. When geopolitical uncertainty spikes, QID will likely see these sudden, violent inflows of cash as institutions buy their temporary umbrellas.
And what about the medium to long term?
In the medium to long term, the asset is structurally designed to erode. The daily reset risk and the resulting volatility decay make it a profoundly toxic asset to hold for anything longer than a highly specific tactical trade.
So that 90% probability of further decline isn't just a market prediction.
No, it's a reflection of the mathematical reality of leverage decay.
It really highlights how treacherous the financial landscape can be if you don't actually read the prospectus and understand the mechanics of what you are buying.
You have to know what's under the hood.
Because an ETF ticker symbol looks exactly like a regular stock symbol in your brokerage app, but underneath, it might be a ticking time bomb of derivative swaps.
It's a highly specialized tool. If you try to use a chainsaw to hammer in a nail, you are going to get hurt. You need to know exactly how the mechanism operates before you engage with it.
Absolutely. Well, as we wrap up this deep dive, I want to leave you with something to really mull over. We've spent this entire time unpacking how dangerous the negative 2x daily reset mechanics of QID are. We walked through the math of how a single layer of leverage and an inverse target can mathematically grind an investment to dust over a few years, leading to a 99% loss of value. But the market always pushes boundaries.
Oh, there's always something crazier.
There are instruments out there with even steeper leverage. If a negative 2x ETF requires absolute perfect timing and a massive geopolitical event just to avoid catastrophic volatility decay, imagine what happens under the hood of a negative 3x fund, like the SQQQ.
The friction doesn't just increase, it compounds at a rate that is difficult to even conceptualize.
Exactly. If a 2x fund decays by 99% over a decade, what exactly happens to the math when you crank the leverage multiplier up to 3?
It's terrifying, mathematically speaking.
Something to think about the next time you are scrolling through your brokerage app and spot a cheap leveraged ETF that looks like a bargain. Thank you so much for joining us on this deep dive into the mechanics of QID. We'll catch you next time.